Welcome back to the Compass. We're recording this episode on, I guess it's Tuesday, August 5th, just after the long weekend here in Canada. I like to timestamp these because the shifts in government policy, which we'll talk about a little bit after this, seem to be moving markets pretty significantly. But let's first talk a little bit about Q1 gold reporting. As of over the last couple of weeks, a lot of the majors have reported. There's still some of the smaller producers left to go. But kind of as expected for us is that, a high gold price has led to better quarters for a lot of the companies, including in particular a Newmont, who are sort of the bellwether. For better or for worse, they're the ones that generalists follow in the industry.
Yeah, and you did say Q1. I think you meant Q2. We already spoke about Q1 a few months ago. But as expected, we've been running these numbers behind the scenes, sort of, at this price, what does it mean for this miner, etc. And we were expecting some pretty spectacular cash flow and sort of overall net income numbers from the larger producers. And so far, from the ones that have reported, and you have the numbers, I do think that that's come to be true. And after we go over the numbers, I'd like to put that in context because the numbers are quite, lack of a better word, quite insane. The amount of money that these companies are making.
Yeah, I think that's a I don't know if insane is the right word, but it's reflective of a significantly increase in the commodity price, right? And we did our, maybe I'm mixing Q1 and Q2 because we did our Q1 show talking about Q2 producers reporting. We started to translate talking about, what that, I think we're talking about free cash flow per day as a metric, which is we started talking about that. It's a ridiculous number, just to start with, when that's in the millions of dollars. But what we said is that all these producers, they're going to flip over into Q2 and that's actually going to do better, right? We had an average gold price of roughly 2,800 in 2,800, 2,900 in Q1. In Q2, it's going to be north of 3,200. Newmont's, I happen to have Newmont's financials up on the screen next to me. They have $3,320 gold was their average sales price. So, that's a pretty significant bump in the gold price, plus 10. And I think that's reflected in the numbers. Now, of course, they all have financial leverage, so it actually it's even better. So you want to look at, we'll start with Newmont since they are the biggest company out there. They did $2.997 billion US in EBITDA, and about $1.3 billion in free cash flow. For rough metrics, they're doing $32 million in EBITDA a day, or $10 million in or $10 million in plus $10 million in or $18 million in free cash flow a day. So that's phenomenal numbers, right? And I think that's what that's what's got the market interested. And I think it helps the overall market a lot that Newmont's actually showing to be profitable. They've gotten through the sales of all those assets. They sort of high graded their portfolio, to use a mining term, and now they're seeing the benefit of that.
You caught me just as I was getting a sip of water. Yeah, obviously, Newmont should be the place to start, the largest gold miner out there. And by reference, obviously, the only one that's a member of the S&P 500, the one that receives the passive flows from all the ETFs. And I do have to say that the numbers surprised me quite a bit because after what we call the upgrading of the portfolio, or the high grading of the portfolio, I think we weren't exactly sure how the remaining operations were going to turn out to be. And this is the best quarter probably in their history. So kudos to them.
Well, they bought, Newcrest had some very good mines and was a really well-run company. And I think that the consequence of putting those two companies together and Newmont being able to carve off, those 5 or 6 asset sales that kind of hit the market at the right time. And I think that's really transformed the company. Not saying out loud that we're buying Newmont at any time yet. I think we got to see a couple more quarters of this to be there. However, kind of the company that we consider to be probably the gold standard as a producer, and has definitely demonstrated that on the flip side, is Agnico Eagle. And Agnico continues to execute and has executed all through this rise of the gold price. They did about $2 billion in EBITDA, and $1.3 billion in free cash flow. So significant, big numbers from them. And keep in mind, they produce just a little over half of what Newmont produces. So if you put those numbers in context, they're producing 2/3 the EBITDA at slightly less than half, just over half the production. So they're getting much more bang for their buck on their assets than Newmont is, for lack of a better description.
You could argue that not so much in terms of dispositions, but the high grading of the portfolio that Newmont is undergoing. It's something that Agnico has been doing constantly over its life.
I think Agnico built themselves that way. Agnico never,
Right.
Very rare. I mean, Agnico has sold assets. It's not unheard of, but they haven't. There aren't a lot of assets in their portfolio that they haven't been able to transform into something. And the fact that they've been able to convert, I think you're seeing that with Detour Lake. That asset has become a spectacular producer. They're doing the same thing with Malartic again. Taking that underground, and they're actually doing something similar in it's not really well talked about, but they're digging into Upper Beaver at which is in the same trend as in Kirkland Lake as Macpherson and those other mines. And so, something they bought years ago, acquired through the Osisko transaction years ago, now is sort of seeing the light of day, and they're expanding that too. They still have growth. They're still spending growth capex significant amounts, and so even with all that free cash flow, and so continue to really continue to execute.
What really struck me out of this quarterly numbers for Agnico is that if you annualize this EBITDA of $2 billion, say $8 billion for the full year, I went out to look at the largest companies in Canada and what kind of EBITDAs they turn around. And this run rate would make, or will make potentially, Agnico the third largest in terms of EBITDA in Canada, only after Royal Bank and TD. It'll surpass everything that was on its way. CNQ, Constellation, the smaller banks, CIBC, Shopify, all of the things that the market has been talking about, the broader generalist market has been talking about since the pandemic, have been completely dwarfed by this moving gold prices and the profitability of this company. I find that quite remarkable and impressive.
And keep in mind, Agnico hasn't exceeded RBC's market cap, which is the death knell for any company in Canada. They have been on a good tear, but I guess maybe reflect on, if you're a generalist portfolio manager in Canada. Let's say that you run an all sectors mutual fund, and generally speaking, you're probably underweight mining 6 months ago or a year ago. What does when you see Agnico's numbers come up like that, what does that mean? When you're sitting there looking at your benchmark?
When you run a portfolio or a fund that has a very well-defined benchmark, you cannot afford to be offside when one of the benchmark constituents is moving higher, which is the case with Agnico and has been the case since last year. If you miss that move, Agnico has doubled. It's gone from, I haven't looked at percentages on the index, but potentially would have gone from, on the TSX 60, it could have gone from 5 to 10%, or from 3.5 to 7%. Those are 3.5 percentage points just on that move alone on the index. You can't afford, those 3.5 points are huge when you run a mutual fund that has that type of a tight relationship with an index where you benchmark against so transparently. So I think it's not so much that the portfolio manager wants to participate, is that they actually have to participate. It becomes a responsive tactic rather than a proactive one. And that's what we've been talking on this show about for the last year. The generalists will have to buy these companies at some point, and clearly they have started doing it. Otherwise, we wouldn't be seeing this type of market caps. But I think that move is nowhere near done, and the delayed reaction is happening right now, and it's still ongoing.
I think part of it also, as you think about it from a psychology perspective, generalists in general have been wrong-footed on mining. Every time they thought something was about to happen, They got their face ripped off when mining companies did what mining companies do, and the commodity either pulled back or they failed to execute, right? And so that, my bet is that they were all hesitant to jump in and be like, oh no, I gotta start adding up on it, Agnico. And keep in mind, you had to buy. It wasn't just Agnico you had to buy, right? You had to buy Agnico, you had to buy Franco, you had to buy Kinross. Any of those companies that make up that TSX 60. If you're a large cap or mid cap gold fund, you've had to go in and buy these names, and that's why this pass. It's not a passive flow, and I don't want to put it that way, but very few of these guys are going to be overweight gold names at this moment, right? And so they're the best in their peer group are, right? And so they're going to be everyone's chasing, which benefits us, right? Because we, for the first time in a long time, as resource investors, we see outside money come into the space because it has to, right?
Right.
And I think that has a benefit, because what that does is what it does, generally speaking, if you look at the history of bull runs, it creates that waterfall effect, right? Where you get, the big companies top, everyone thinks they're expensive. In the meantime, your small companies, your developers, your smaller producers have all kind of gone up, but not at the same rate. And then all of a sudden there's a catch-up trade because everyone missed the move of the big caps, and so they want to buy the next best thing, and that puts rocket fuel, right, or of course gasoline on the fire for the developers and small producers, which I think we're seeing in a select way, but I think is still got more room to run.
Absolutely. We've talked about the waterfall and how the money gets recycled down cap effectively. We're seeing it with companies like Lundin Gold. We're seeing it with a few select ones that, even though they don't have the production or the scale of Agnico and that top group, they have the panache and the right people behind them. So they're the first ones to attract those dollars. But I think what we're trying to say is the move has started, and it's very unlikely that it gets interrupted halfway. The most likely scenario is that the money continues to trickle down, and we continue to see a cycle where the more risk you take in terms of market cap, the higher the potential reward at the end of the cycle.
And for those, and what that means, though, for you junior mining junkies who have to buy the Explorco that has pink dots, your Explorco will get its day. It's just we're not quite there yet. But we're seeing it in select ways. I think that's a big thing, right? We're seeing in select ways that if you have really good drill results, those are being rewarded. If you have a developer where you have a study that changes the project, we're seeing that get rewarded. Mostly in the gold space, almost entirely in the gold space, but I think that's critical. Other company we should mention, because it's near and dear to our heart, as we could circling back to Q2 reporting, was Anglo. Anglo is as we talked about, I think last week or our last episode, is one of our large cap investments. They had a very solid quarter, 1.4 billion in EBITDA, $535 million in free cash flow. They produce about the same amount as Agnico, so obviously not at the same level there, and a little bit more reinvestment going on, but still very, very good numbers. And they're in the process. They're in the process of trying to really improve they're improving, which I think is part of the reason why I think they perform so well, and I think why there's still opportunity for them to run.
Yeah, and just the risk of repeating some of the key points of last episode on Anglo. It's not just the cash flow and the profitability of the company and the low multiple at which it's trading that is attractive. It's also that it has embedded within it probably the most attractive gold growth development project in the world today. It's in a fantastic jurisdiction in Nevada. We talked about it last time. Lifetime, project, multi-generational. Probably we're not going to be here when they finish mining this asset. I cannot ascribe enough intangible value to the project on top of obviously the value of the in situ of the 14 million ounces that are currently in the resource, but all of the other ones that are likely going to be added over the next few years.
It's something that's worth noting, right? And just as we look through this, the other thing with Anglo and things that back to generalists taking notice, right? Because this is the space where generalists get into the space. Their free cash flow is up 150% year over year, which means versus Q2 24. Very different gold price environment, very different look, but those are massive numbers, right? As far as free cash flow goes. So growth, that's a headline grabbing number that generalist investors might look at. So I think maybe to put a bow on Q2 reporting and kind of line it up, something that is, I think, is, good companies are continuing to execute as far as we can tell. I think that's good for the space in general. I think it continues to attract capital to the space as those companies execute. And then, as we were talking earlier, that bodes into, leads to that money flowing downhill, whether it's larger resource funds flowing downhill, which we've seen a little bit of, if you look at some of the funds that have reported, or you see larger cap or just generally valuations going up for those smaller producers and developers.
Yeah, and just to wrap it up, I do want to say, one of the important things about this profitability is that when you actually think about the biggest pool of capital for investments in the mining industry are mining companies themselves. So the fact that these companies are having record profitability means that there is more capital available for our sector, and that's evident by Anglo has done two pretty serious acquisitions in the last 12 months, and a handful of others in the 12 months prior to that. So certainly some companies are being very aggressive with that capital, and Anglo won't be the last one. And the deal we saw, the recent deal that they purchased in Nevada won't be the last one in the cycle for sure.
Yeah, I think that's I think we're going to see a lot more 19.9s and 9.9 type investments. A lot of these companies have a lot of money. They can't develop everything all at once. I think that bodes, like I said, that bodes well for the smaller producers and developers in the space. We've already seen a pickup in M&A. We saw Torex has bought Prime in Mexico, which has a whole other set of implications associated with it. So I think that there's that pool of capital that these large companies have is going to get put to work. Whether that's, some of that will be building new projects in their pipelines. In the case of probably. But in the case of a lot of these companies, it's going to be reinvesting outside because they don't have significant, other than Anglo, none of the other majors have significant growth pipelines.
But also the part of the waterfall formation that we're talking about also implies that lower down cap, the valuations are more attractive than higher up. So if these companies have this profitability, it will be accretive to them to buy stakes or outright buy projects, even if it's only to put them in inventory, while that delta is open, because at some point, at the end of the cycle, it typically closes or reverses, where the exploration or development projects get valuations that are undeserved, or at least greater than what the producers get. And at that point, when you see that, we're closer to the end of the cycle, but certainly at this point. And we've talked about some of our favorite developers, that valuation gap and that accretive opportunity is certainly still open, and it's wide.
I could not agree more, which is why we hold a lot of our position in that, as a lot of our position, a lot of our assets in positions and developers, just for that very reason. As we expect M&A to continue to pick up, and these tend to be the assets that perform very well across the cycle, start from low valuations, pick up things at pennies on the dollar per ounce in the ground, and then they get taken out for hundreds of millions. And so that's where we are. A couple other things, with that, putting a bow on Q2 2025 reporting. A couple other things we want to mention, and probably we've been talking a lot about royalty transactions, and this morning Royal Gold announced a deal, a little bit of a different deal from your traditional NSR trading. Royal Gold announced a gold streaming deal with First Quantum on their Kanishi asset in the DRC, in Zambia.
Kansanshi in Zambia.
Yeah. And so, Sam, you took a quick look at it. What do you think?
Yeah, for a start, it's not an easy valuation. There's a lot of embedded options for buybacks and for to lower the ounces deliverable, et cetera, et cetera. But I did my best, and effectively, we like to look at royalty transactions in terms of what percentage of the in situ value at today's prices did they pay for. And typically, we see something between 70 and 90%. We've shown you other previous transactions where, recently we've been in the high 80s. I've come to the point where this one is it's in the mid 50s. It looks very accretive for Royal Gold at first sight. I do have to say this is a very long life asset. So if we don't account for time value of money, that's partly because inherently if gold is an inflation hedge, technically it should give you at least the rate of return of inflation. So if you don't discount it, then the net present value is the same as the in situ value at today's prices. So they've paid about just in the 50 to 55% range. That's on the lower end for what we're used to. That's only adjusting for the fact that it's a stream. So obviously I've deducted the ounces that effectively they're paying a percentage of spot. So I've taken those ounces off. And looks like a pretty interesting deal and pretty attractive deal for Royal Gold. Remember, they're coming off the back of having bought Sandstorm. The deal hasn't closed yet. They were going to announce 3 or 4 weeks ago. And they also did they also did recently another deal. So they're on a pretty aggressive acquisition spree here in terms of assets. But this one looks particularly attractive and of interest to us and development assets. Kansanshi in the Zambia, it's a very interesting asset for First Quantum because there are a lot of interesting juniors around it. In particular, one that we have a position in is Midnight Sun, which is a company that's exploring effectively on the fringes of the Kansanshi deposit, and stands in a prime position to be consolidated with First Quantum should they want to increase their their life of mine, but also the mix. There's some technical elements here of a mix of oxide and sulfides that I don't think it's a point of getting into this episode. But all in, I think it's a great deal because Royal Gold is paying a very attractive multiple, at least on the way we value the royalties. But also for First Quantum, this gives them a liquidity injection at the time when they may be either closing into the time when they get a deal to restart Cobre Panama, or essentially a capital injection to invest in their future outside of Cobre Panama. So I think it's a good deal for both, which is not often the case when we talk about deals. So pretty happy to see this morning.
And not an insignificant investment, right? It's not like it's a couple $100 million. This is $1 billion transaction for Royal Gold. And probably it's a lower discount on the ounces. Sorry, it's a higher discount on the ounces simply because of the options that First Quantum has to get out of it. So, which makes sense. I think I kind of agree with you, and it does. Obviously there's a commitment there for First Quantum to want to be there for a long time, and that bodes well for Midnight Sun. And Midnight Sun, probably an episode out of itself to talk about why the oxide mix and why that works for Midnight Sun, and probably actually works in the streaming deal too, because that'll be predominantly the oxide production is predominantly copper and doesn't come with gold. But anyway, neither here nor there. Very interesting. The other thing we want to mention, and I think we're only got a couple minutes to talk about it here, but I think it probably warrants its own deeper discussion at some future date. Is the introduction of price floors now by both the Australian government and the U.S. government, which is for certain commodities, which is particularly commodities that are controlled by China. So
yeah, I think we don't want to get into the specifics because I think the message we're trying to convey here is the general message of my former boss, Frank, whom he used to say government policy is a precursor to change. And what he meant to say when he said that is you should never invest against government policy because the government always has more resources than you and can exhaust you and effectively ruin you. But conversely, like in this case, when the government policy is in your favor, that's when you have to go all in because the stars are aligning in your favor. And I think this is the another step in this process where governments have finally, and I really mean finally, after so many years, sort of changed trend when it comes to mining and resources, and have realized the importance of the industry and are now in a position where they're willing to support it both with money but also with policy change that would allow projects to be delivered more effectively, more quickly, etc., and at a lower cost. And I think in the case of this week, the Australian government has taken some steps to effectively fund some units of Nearstar or Trafigura to keep some of the smelters open. But that's sort of like the teaser of a new political project that's going to be presented, which aims to set price floors, like you just mentioned, for certain commodities that are considered or deemed strategic, and like you rightfully said, effectively the ones that are controlled by China. But in this big wrapper, what you have to read through is, when the government is finally behind you in your industry, it's the right moment to invest and it's the right moment to take some risk.
Yeah, I mean, I would have told you maybe 2 years ago I wouldn't have touched North America, rare earth deposit. I mean, Mountain Pass, the project that the U.S. government or the U.S. Department of Defense just funded the company, funded the project, and set a price floor on some of the rare earths. That project's gone bankrupt at least twice. China has, has effectively built smelter metal refining capacity that no one else in the world wanted to do. We all exported our pollution to them so that they built all this refining capacity. And now the consequence is that we don't have any, and they control all these metals. I use this example for a lot of my non-mining friends, but the metal that China controls the least is copper. And copper only because they don't really have significant in-country supply, and only about 66% of the world's copper flows through Chinese smelters. That's the one they control the least, right? And so a lot of only. So so this is what's happened over basically a generation, the last 20 to 30 years, or half generation, is that we as the Western world have elected, and now elected to make those types of operations uneconomic, and the consequence is that China let them be economic. We exported our pollution effectively, and so now we have the government has to act to control them, because China is weaponizing that control, particularly in rare earths and things like tungsten and a few other things, antimony. And I think you're going to see those, particularly when it comes to in the U.S., particularly when it comes to sort of defense critical metals. I think you're going to see that they're going to pick winners, and I think it's something that's important for all of us to keep in mind as we look out and invest. And like I said, 2 years ago I wouldn't have touched Mountain Pass with a 10-foot pole. And now it's one of the hottest investments in the mining space.
I can't be more excited about the political wins in our industry. It started with uranium a few years ago. Then remember that natural gas all of a sudden made the green investment list. I still talk to a lot of people here in Europe, and they tell me that their sustainability metrics don't allow them to invest in mining and metals. But again, that's going to change. It's that unfortunately they're going to be the ones that are going to be buying at the end of the cycle, when the last pin drops for all the policies to align in favor of the industry. But we've already seen big steps from governments and from certain parts of the industry, and I think there's going to be ups and downs, like there always are, and I wouldn't be surprised if we get some correction here. But generally, I think we're in a multi-year uptrend here for the entire sector, and I'm pretty excited to be part of it.
Yeah, I think it's definitely something that we as an industry or as investors in the industry certainly need to be keeping an eye on and looking at. And I think probably Sam need to do an episode just talking about that, some of the metals that we think might be impacted, and maybe some of the names that we have in our portfolio that fit that. Because it's kind of across the board. It's pretty much everything but precious metals, almost. It's that broad based. So I guess with that, looking at the time, we're getting to the end of this episode. Just to recap, really good Q2 reporting from the producers, which is good for the industry. Them not falling on their face is positive. Talked a little bit about a good deal that another $1 billion royalty transaction that Royal Gold did with First Quantum, and don't fight the government, which seems like the antithesis of for a lot of our American friends. But anyways, that's where we are. Look forward to speaking to you all in on the next episode. Thanks.